Good afternoon, ladies and gentlemen. My name is Sheng Shiong and I'm standing in for Dylan today. We have so many events last week that their collective outcome will no doubt drive significant volatility for markets this week. First, we have the US brokered peace deal between Israel and Hamas, a deal which is effectively broken into two parts. The first of which requires Israel's withdrawal from parts of Gaza, increase in humanitarian aid, and the exchange of prisoners. The second part of the deal is actually way more complex. It calls for Hamas disarmament and the formation of an interim government to oversee Gaza. Negotiations for phase two could start as early as Tuesday once the prisoner exchange is completed by Monday. But as you've already seen on the news media and papers, that Hamas is already mobilizing fighters as fears of internal violence mount. And then we have the US China trade war. Beijing has vowed countermeasures against Washington if President Trump makes good on his threat to impose 100% tariffs on Chinese imports by November the 1st. S&P 500, Bitcoin, Ethereum all fell by a wide margin over last Friday. So we're back on this key question today. How bad will things get, and will the sell-off actually be unidirectional for a long period of time? Borrowing a quote from Stephen Inez, who is MD of SBI Asset Management, he once said in his newsletter that while market valuations may be stretched, markets do not die of altitude, they actually die of exhaustion. Stephen is a regular commentator on the South China Morning Post and a major contributor to other financial publications. What he's saying here is that these events are taking place at a time when interest rates are still nowhere near the zero line, as they are as they were for more than a decade after the financial crisis. So additionally, central banks have also been withdrawing liquidity through quantitative tightening. So the reinjection of liquidity could actually stabilize markets if things get really out of hand. So today, our panel of speakers will take us through key technical support levels, things to watch over in China, and how to play defense with stocks as well as with Sheng Shiong. So without further ado, let me first invite our first speaker to the podium. Amiru is our regional chartist. I'd like Amiru to first walk us through the key support levels to watch for US indices and the SDI. Amiru, could you walk us through, please?
All right, hi Sayang, thanks for having me. So let me just share my screen first. So in order for us to access the current market situation, so obviously we have to look at the major indices such as the S&P 500. So what we're going to do today is we're going to access how the US market is currently doing before we take a look at the Singapore market. So over here, I have the chart of the S&P 500. So obviously, if you look at the chart over here, we have been in a strong and nice uptrend. And when we thought that the market is just going nice and smooth, last Friday, as we all know, if you have been reading the news, the S&P 500 went through a sharp sell-off or sharp decline. It declined by more than 2.7%, which is its largest decline since its April 2025. So we could see over here, if you look at the chart over here, even though we can see that the broader uptrend remains intact, however, just like what Sangya mentioned earlier, maybe the sell-off is the sign of the uptrend is facing an exhaustion phase. However, if you look at the chart over here, if you just take a look at this orange line over here, right, this has been a very important support line since the index has started this uptrend from its May 2025 low over here. So for me, if you look at the chart over here, we could just draw a short uptrend line over here. We could see that if you could just draw this black line over here, this black line over here is the uptrend line, which coincides with its 50-day SMA. So in order for us to know whether this panic sell-off is a temporary sell-off or actually a bearish reversal move, we take a look at this black line over here where the 50-day SMA is currently at 6525. So if let's say the sell-off continues tonight and it breaches below this orange line over here, that could be an early sign of a bearish reversal. However, if you look at the orange line over here, this orange line over here is where I put my major support line, which is currently at 6340. And why we put 6340 as our major support line? First reason is because it has previously, this line over here has been touched multiple times before. You can see over here, from August 2025 readings. And also, if let's say the index breach below this line over here, we might see this 21-day EMA line, which is this blue line over here, could actually cross below this 50-day SMA line, which is a stronger sign of a bearish reversals, just like what we have seen from this February 2025 peak over here. When this blue line breaches below this orientation over here, this is when the panic sell-off started, and it just started a new downtrend. So watch out for the first support level of 50-day SMA and also this key support level of 6340. So the same story goes to the Nasdaq 100 as well. So if you look at the chart over here, the index just breached below its 21-day EMA. However, it maintains a 50-day SMA line. And for Nasdaq 100, it's even more important to watch out for the 50-day SMA line. And it has proven to be an important support line. For example, from this August 2025 move over here, this is the move from 21 August. The index almost touched its 50-day SMA before rebounded. And this one from 2nd of September 2025, it already went below. However, it rebounded back above before it just continues its downtrend. So if the index just continues to trade lower and breaches below this 50-day SMA line, this could be a sign of a bearish reversal. However, the major support line could be around this level over here, where the index has previously touched this line multiple times at 23,000. So let me just readjust the reading for one moment. So the 23,000 would be the major support line. So if you're wondering whether how the market is looking right now, if you look at the futures reading, right, the US futures reading, they all went up. So probably the sell-off could just be temporary. So this is due to this recent statement made by Donald Trump on his Truth account, where it says, "Don't worry about China, it will all be fine. How you respect the presidency. I just had a bad moment." So probably this sentiment has been lifted up by that statement. So if you are looking for some trading opportunities, we highly recommend fellow investors to look for defensive counters. So for example, if you look at the earnings, we are just start our third quarter 2025 earnings, and for tomorrow night, big financial names such as BlackRock, Citigroup, Goldman Sachs, JP Morgan, and Wells Fargo will actually announce their earnings. So one of these names that I will recommend to watch out for will be JP Morgan, which has one of the best charts out of all. You can see over here, the 50-day SMA also has been proven as an important support line. So if let's say the earnings went well tomorrow, I believe it could rebound back from its 50-day SMA and it could actually resume its broader uptrend. So that's it about the US market. So how about the Singapore market? So over here, I have the chart for the Straits Times Index. So if you look over here, the index went down by 1.07% for this morning session. So we could see this is its sharpest decline since, I think, since July 2025. Yep, since July 2025, where it once declined by 1.0%. However, just like the US market, the broader uptrend remains intact because this chart over here looks even better than the US market just now, as this gap down over here managed to find support from its 21-day EMA line over here. So we could see that maybe this sell-off could be temporary. However, if it continues to trade lower, so our major support has been set at 4260, because if it breaches below 4260, it could also breach below its 50-day SMA line, which could also lead for the 21-day EMA to continue to slope downward and reach and made a bearish profile over below this 50-day SMA line. So for us, the overall uptrend remains intact despite the sharp gap down. However, watch out for the major support level 4260. And if one counter that I could suggest for us for the Singapore market, it will be this counter. It is not a bad counter, but a real estate counter, which is one of the defensive sectors, which is GUL Group Limited. So we could see over here, Singapore market overall this morning has been quite weak. However, for UL Group Limited, it remained resilient, and in fact, it just managed to go 1.38% higher to close at its new all-time high. So if you look at the yearly chart over here, you can see this index, this counter managed to make a new all-time high. So obviously the upside remains intact. So this is the type of counter that we want to look for when the market is weak, where a market managed to survive the weakness, right? So major support level could be set right around this level at 7.70 over here. So if you're still holding the counter, I will highly recommend to actually raise your stop loss to lock your profit. And to those who have not yet locked in into UL Group Limited, I believe this could also serve as a buying opportunity, given that this all-time high over here came with low momentum, as in you can see over here, the volume increased, but it It's not as high as what we've seen in the previous sharp gap up over here. So that's all for me today. Over back to you, Sang.
Thanks, Amiro. That's quite interesting. Looks like a play on the interest rate cycle. As interest rates go down, they tend to have a positive impact on real estate stocks as well as REITs. There's another question on the Singapore market, which I hope you can answer as well, Amiro. What about Seatrium, Seatrium?
All right.
Is Seatrium still looking positive on your charts?
All right. Let me Citrium Limited, right? So 5E2. All right. So if you look at the chart over here, so Senya, the chart don't look as good as UL, obviously, because the chart, the price movement over here has actually made a two consecutive gap down where it just breached below both of its moving average line over here. However, obviously, I don't really recommend to buy into a dip. So obviously, this is now in its deep momentum. So if we draw our uptrend line over here, we could see that the index, once it breaches below this uptrend line, it just started a new downtrend. However, it could be something to be put on your watch list because you could see over here, this RSI reading, it is entering its oversold territory over here. So if you look at the previous moment where this price went back in April 2025, when the RSI breached into its extremely oversold territory below the 20 level, it just started a new nice uptrend over here. So if you look at the chart over here, maybe because this RSI readings over here has not yet entered its extreme oversold territory, so the downside remains. However, we could see over here the strong support as is 200-day SMA. So if let's say the price rebounded and make a structure that looks like this, it rebounded and it make a new higher low structure like this one. So we want something that provide a new base and also a new higher low structure. So if let's say that happened, that could be a fresh buying opportunity. For now, it's not yet a buying entry, but it could be in the future, in the near term, as it is entering its oversold territory. Hope that answers your question, sir.
Yeah, that's really insightful. Thank you so much for that, Amiro. And I hope that answers your question, Jeffrey, who had submitted this question on the Q&A. Let's move over to China right now, and I'm very happy to bring on board Erica, who's our China economist. Erica, so China will be convening the fourth plenum from October 20th to the 23rd, and it will also be releasing the draft for the 15th five-year plan. My first question to you is, did China actually meet its 14th five-year plan goals?
Yao, so the 14th five-year plan, it spans 2021 to 2025. And I would say that China had mixed results in fulfilling some of the bigger goals. So it has a number of goals set out. So, for example, increasing the share of the services sector in the economy, and also increasing the rate of urbanization, and expanding the social safety net, and also increasing scientific innovation. So I think on the first two counts, in terms of increasing the share of services, unfortunately, that share has been quite stagnant in the last 5 years. Also, the urbanization rate seems also to have run into its natural constraints. So obviously, the ability to meet some of these goals has been complicated by two unexpected major events in the last 5 years. So number one has been COVID and its disruptions. And then secondly has been the re-election of Donald Trump and his global tariff war. So I think going forward for the 15th five-year plan, definitely China will try and catch up on lost time. But one of these 14th five-year plan goals that it was wildly successful in has been to double down on high-tech innovation. So you can see that the state has invested a lot of funds as well as talent into the endeavor. And as a result, in terms of its global supremacy in things such as robotics, healthcare, pharmaceuticals, AI, and even electric vehicles, you can see that the fruits of the government's policy have really been quite obvious.
Okay. All right. Thanks. So when we look forward to the 15th five-year plan, do you reckon that there might be a change in terms of how China plans to sustain its growth over the next 5 years?
So I think that for the 15 five-year plan period, which spans from 2026 to 2030, the government will try and meet some of the long-term challenges that China is going to face. So three of these challenges. Number one is a rapidly aging population. So what are they going to do about it? I think they're going to double down on the provision of some consumer services because an aging population is going to have rapidly growing needs for healthcare and elderly care, as well as pharmaceuticals. So we see China trying to ramp up its supply of these goods and services to make sure that the country can provide for its people, high quality and cheap offerings. And also, we see that China's advantage is no longer going to be in an endless supply of low-wage labor. So, who's going to replace these low-cost factory workers? Robots. So you see that China has actually been expanding its deployment of industrial robots. So that's going to continue. The next challenge will be the property sector. So as we know, our property sector has been in decline for some time now, and the government hopes to slowly whittle down its size. Now, the thing is that China is still sitting on a massive oversupply of unsold homes. And unlike cars or solar panels, China cannot ship these unsold homes. So these are known to be the non-tradable sector. So non-tradable means it cannot be exported elsewhere. So I think China, what it hopes to do is to invest heavily to tilt the economy towards the tradable sector. So you will see that they will be at the forefront of some of the consumer durables that the world needs, such as electric vehicles. And finally, the biggest challenge and the elephant in the room is geopolitical rivalry. So as part of the 15 five-year plan, we expect Beijing to also intensely try to build a regional flying geese ecosystem. That means an industrial ecosystem with China at the lead, but also with regional countries in Southeast Asia plugged into that manufacturing supply chain.
All right, that's interesting. Erica, if we look at the escalation of trade and technology frictions, especially between the US and China, what's your view on China opening up its service sector to foreign investments? Are they going to have a better shot this time round compared to the 14th five-year plan?
Yes, so I think that China is going to push forward with opening up access to its domestic services sector in some clusters. And I would divide the services sector into those that are ripe for more opening up to foreign players, as well as those that are still no-go zones. So which sectors are up for grabs for foreign players? Obviously, healthcare, because China has huge and increasing needs for healthcare given its aging population. So we expect it to open its doors further for medical services providers as well as hospitals. And also another industry in this sector that's primed for expansion is education. So we can expect to see greater openness in terms of market access to providers of education at all levels, from kindergarten all the way to tertiary. Now, which are the services that are no-go zones? So I think, unfortunately, services that are seen to be of strategic importance to the national interest, such as financial services and telecoms, as well as transport. I think the country will still like very much to keep those industries in state hands.
Okay, great. Thanks very much for those insights, Erica. Let's go over to Sheng Shiong at the moment. Sheng Shiong has been in the limelight, um, especially during times like that, because it's deemed to be a very defensive stock. It's consumer staples. People have to eat, people have to shop for groceries. So I'm very happy to have Husseini with us this afternoon. He's just reinitiated his call on the stock. He's very bullish on Sheng Shiong. So let me first table the first question to Husseini. Husseini, on the macro side of things, what are the key drivers that support your optimism for Sheng Shiong?
Yeah, sure. Thanks, Sheng Yao, for having me. We are, as you said, we are very positive on Sheng Shiong. And on the macro side, there are multiple drivers in place, and I'm borrowing some of the work which our economics team has done, that there is a construction boom going on in Singapore. Okay, and our economics team expect that the construction sector to grow at a rate of 5% plus rate till 2030, and construction sector needs foreign workers, and as a result, there is a bigger intake of foreign workers, and because of that, population growth has reached almost 1.2% in the first half of 2025. So that, in my view, is a positive driver for Sheng Shiong as the population expands. So that's one of the catalysts. The other catalyst is that there is quite a bit of government handouts, and that feeds into the demand for the supermarkets. SG60 vouchers are one of them, and SG60 vouchers, around $2.2 billion of vouchers being disbursed. Of that, around 50% will end up, in my view, with the supermarkets, and the validity of those vouchers are till the end of next year. On top of that, there will be multiple CDC vouchers as well, likely will be provided. So that that also remains a supportive factor. The third supportive factor is the constant supply of HDB blocks, new HDB blocks. So that will in turn allow the likes of Sheng Shiong to open new stores. So given all these factors, we are of the view that the overall supermarket growth is likely to remain elevated, and as such, it should grow at a trend line which is superior than what we had seen in the past. Just to look into the just to look into the July and August spend itself, it was almost 9%. The supermarket growth was 9%. So it is already getting reflected into the numbers.
Okay, great. Husseini, to that second last point that you made about Sheng Shiong's network here in Singapore. Now, the Singapore mart openings have already hit Sheng Shiong's target store count this year. Are your estimates actually on the conservative side?
Okay. So no, means the simple answer is that we started on a very bullish mark. So at the start of the year, when the company gave its guidance, they said that they are looking to open 8 stores this year, and that 8 stores is also very much on the higher side, because they had, I think, around 75 stores. 8 stores would have taken them to 83 stores. Okay, but as of today or last week, they have already opened 10 stores. So 8 was the target. They have already opened 10 stores. And in our numbers also, we had 10 stores, but by the year end. Okay. So they have exceeded their guidance and exceeded well ahead of the time. What we also see, and we have done some channel checks, and that is on the screen, that we visited their few of their stores in Kenex Mall as well as in the Cathay Mall, and the footfall we see is much superior because these are even the new stores, right? So the ramp up takes time, around 12 to 18 months, but still in the second, third, and fifth month, we see that the footfall was quite good. And when at the same time, when we visited the nearby stores of DFI, which is Giant and Cold Storage in places like, say, Plaza Singapore or Marine Parade, we see that they were relatively subdued footfall. So relative to the competition, we see that Sheng Shiong is pushing ahead, and their stores, new stores, are seeing good traction. Point to note over here is that uh, Sheng Shiong, while added 10 stores year to date, the DFI group has closed 2 stores. Okay. And we also did some more channel checks like Google reviews. On Google reviews, uh, Sheng Shiong is Sheng Shiong's Google reviews are around 4.4 versus for fair price it is around 4.1, and for cold storage and Giant it is somewhere around 3.8 to 4. So Sheng Shiong also is ahead on that. So net from the competition point of view, they are tracking ahead and they are doing better than its competitors in our view.
Okay, great. I think that also answers the question that was just posted on the Q&A box in terms of who is Sheng Xiong's key competitor. Now, on that note, let me just ask you one final question on Sheng Xiong's valuation. So, Sheng Xiong is already trading above the international peer group basket based on your latest report.
Mhm.
And if we compare against the Asian basket, where does Sheng Shiong stand in terms of valuation, and what is your price target predicated on?
Yeah. So uh, based on the Asian valuation comps, Sheng Shiong for the next year is somewhere in line. Okay. So it is not overly expensive or overly discounted. But where we see is that the growth for Sheng Shiong is superior compared to its regional averages, right? So from a growth adjusted valuation, it is relatively cheap. Our valuation, our 2.3 dollar target price for Sheng Shiong is based on a DCF model with around $7.8, 7.8% WACC. And on our valuation, it will be trading at 21 times price to earnings ratio for next year. No, for this year, I mean to say. And that is bit higher compared to the regional average. But given the superior growth we see and the kind of catalysts we see for the company, we are of the view that a slight premium is warranted.
Okay, great. So we have a buy call on Sheng Shiong. For any of our audience here today, if you're interested in this report, you can either download it from the Maybank Trade application, or you can contact your sales representative to get a copy of the report. So we've come to the end of the program and really appreciate your time with us. I want to also give my thanks to the panelists who had shared with you the stock picks today and their view and Erica's view also on China. If there are any questions that you feel that you need to deep dive further, again, please contact your sales representative, and we would be able to address your questions if any. Right. So with that, thank you again. We look forward to meeting you again in the next show next Monday. Thank you very much.